Indian Economy by Ramesh Singh. Chapter 14. Security Market in India. Had there been no security market, undoubtedly, the most fascinating segment of the financial market, there won't have been the big MNCs and TNCs in the world. Once the world moves towards the process of globalization, the potential of this market has increased exponentially. Its capacity of resource mobilization is just anybody's guess. The segment of a financial market of an economy from long-term capital is raised via instruments such as shares, securities, bonds, debentures, mutual funds, and is known as the security market of that economy. Definition: a security market has components such as a security regulator, SEBI in India, stock exchanges, different share indices, brokers, FIIs, jobbers, etc. There are different kinds of transactions which take place in a security market such as badla, reverse badla, future trading, insider trading, not allowed, private placement, etc. Primary and secondary markets. Every security market has two complementary markets, primary and the secondary. The market in which the instruments of security market are traded, procured, directly between the capital raiser and the instrument purchaser is known as the primary market. As for example, a share being directly purchased by anybody from the issuer, which may be the company itself. The person is known as the primary shareholder. The market where the instruments of security market are traded among the primary instrument holders is known as the secondary market. Such transactions need an institutionalized floor for their trading, which is made available by the stock exchanges. Stock exchange. A physically existing institutionalized setup where instruments of security stock market, shares, bonds, debentures, securities, etc. are traded. It serves the following major functions. 1. Makes a floor available to the buyers and sellers of stocks, and liquidity comes to the stocks. It is the single most important institution in the secondary market for securities. 2. Makes available the prices of trading as an important piece of information to the investors. 3. By following institutionalized rules and procedures, it ensures that the participants in the stock market live up to their commitments. 4. Passes updated informations to the enlisted companies about their present stockholders, so that they can pass on dividends, etc., to them. 5. By publishing its index, it fulfills the purpose of projecting the moods of the stock market. World's first stock exchange was established in Antwerp, Belgium, then part of the Netherlands, in 1631. The London Stock Exchange opened in 1773, and then Philadelphia Stock Exchange, the first in the New World, opened in 1790. The first stock exchange in India, the Bombay Stock Exchange, known as the Native Share and Stock Brokers Association, was set up in 1870, under a tree. Top 5 largest stock exchanges, on the basis of market capitalization, of the world in their decreasing order are the New York Stock Exchange, the Nasdaq, the Tokyo Stock Exchange, the London Stock Exchange, and the Bombay Stock Exchange. Trading in the stock exchanges takes place via the mediators known as the brokers, the jobbers, the market maker, discussed later in this chapter. As per the latest information, presently, there are a total number of 26 stock exchanges operating in India, 7 at the national level and rest 19 at the regional level. One of it, Coimbatore Stock Exchange, recently sought for withdrawal of recognition. The matter is sub judice under SEBI. A brief account of the national level stock exchanges is given below. NSE. The National Stock Exchange of India Limited, NSE, was set up in 1992 and became operationalized in 1994. The sponsors of the exchange are financial institutions, including IDBI, LIC, and GIC, with IDBI as its promoter. It has a 50-share index and a 500-share index known as S&P CNX 50, Nifty 50, and S&P CNX 500, respectively. OTC. Though the Over-the-Counter Exchange of India Ltd, OTC, was set up in 1989, it could commence trading only in 1992. India's first fully computerized stock exchange was promoted by the UTI, ICICI, SBI Cap, among others, in order to overcome problems such as lack of transparency and delays in settlements prevalent in the older stock exchanges. Another important goal of the exchange was to allow stock market exposure to comparatively smaller companies with paid-up capital from 30 lakh rupees to 25 crore rupees are enlisted here. Trading in this exchange takes place via market makers and commission is fixed. IC. The Interconnected Stock Exchange of India, IC, is basically a single floor of India's 15 regional stock exchanges, RSCs, set up in 1998. The RSCs were provided increased reach through this. It is a web-based exchange. BSE. The Bombay Stock Exchange Limited, BSE, earlier a regional stock exchange, converted into a national one in 2002. The biggest in India, it accounts for almost 75% of total stocks traded in India and is the fifth largest in the world on the basis of market capitalization. There are at present 4 indices connected with the BSE. 1. Sensex. The sensitive index, i.e. Sensex, is a 30 stocks index of the BSE, which was enlarged to include 50 stocks in 2000 but soon was cut down to the original level. This index represents the Indian stock market. 2. BSE 200. This is a 200 stock share index of the BSE, including the 30 stocks of the Sensex, which has its dollar version too, the Dolex. 3. BSE 500. In mid-1999, the BSE came up with a 500 stock index representing major industries and many subsectors of the economy, with information technology getting a significant weightage. 4. National Index. An index of 100 stocks being quoted nationwide, Bombay, Delhi, Kolkata, etc., was developed to give broader or wider representation of the stock market, since the Sensex consists of only 30 stocks. The 30 stocks of the Sensex are included in the National Index. This index is computed by the Statistics Department of the BSE, hence it is called the BSE National Index, BSENE. Indonext. A new stock exchange to promote liquidity to the stocks of the small enterprises, SMEs, was launched in 2005 jointly and medium the BSE and the FIC, Federation of Indian Stock Exchanges, representing 18 regional stock exchanges. It is better known as the BSE Indonext. It was also an effort to rejuvenate the RSCs, which were facing falling volumes of trading on their floors. Due to absence of trading at the RSCs, the stocks of the SME has become illiquid. The BSE will transfer all its B1 and B2 groups to this exchange. The RSCs also transfer their enlisted companies to the new exchange. Now the RSCs will be able to use the BSE network online, the WebEx. SME exchanges, BSE SME and Emerge. SME Exchange is a stock exchange dedicated for trading the shares of small and medium-scale enterprises, SMEs, who, otherwise, find it difficult to get listed in the main exchanges. The concept originated from the difficulties faced by SMEs in gaining visibility or attracting sufficient trading volumes when listed along with other stocks in the main exchanges. To be listed on the SME exchange, the post-issue paid-up capital of the company should not exceed 25 crores rupees. This means that the SME exchange is not limited to the small and medium-scale enterprises, which are defined under the Micro, Small and Medium Enterprises Development Act, 2006 as enterprises where the investment in plant and machinery does not exceed 10 crores rupees. As of now, to get listed in the main boards like National Stock Exchange, the minimum paid-up capital required is 10 rupees CR and that of the BSE is 3 rupees CR. Hence, those companies with paid-up capital between 10 rupees CR to 25 rupees CR have the option of migrating to the main board or to the SME exchange. The companies listed on the SME exchange are allowed to migrate to the main board and when they meet the listing requirements of the main board. There shall be compulsory migration of the SMEs from the SME exchange in case the post-issue paid-up capital is likely to go beyond the 25 crore rupees limit. World over, trading platforms or exchanges for the shares of SMEs are known by different names such as alternate investment markets or growth enterprises market, SME board, etc. Some of the known markets for SMEs are AIM, alternate investment market, in UK, TSX Ventures in Canada, GEM, growth enterprises market, in Hong Kong, Mothers, market of the high growth and emerging stocks, in Japan, Catalyst in Singapore and Chinext, the latest initiative in China. See World Federation of Exchanges for latest comparative idea. Globally, most of these SME exchanges are still at an evolving stage considering the many hurdles they face. 1. Declining prices of listed stocks and their illiquidity. 2. A gradual reduction in new listings and decline in profits of the exchanges, etc. For instance, AIM had 3 predecessors. Catalyst succeeded SESTAC with new regulations and listing requirements. 3. In most jurisdictions, idea of a separate exchange for SMEs have become unviable and hence tend to be platforms of existing exchanges, perhaps cross-subsidized by the main board or exchange. In India, similarly, after the 2 previous attempts, OTC, Over-the-Counter Exchange of India, 1989, and Indonext, the market regulator, SEBI, on 18 May 2010 permitted setting up of a dedicated stock exchange or a trading platform for SMEs. The existing bourses or stock exchanges in India, BSE and NSE went live on 13 March 2012 with a separate trading platform for small and medium enterprises, SMEs. BSE has named its SME platform as BSE SME, while NSE has named it as Emerge. Unlike in India, many of these SME exchanges in various countries operate at a global level due to smallness of the market, allowing for listing by both domestic as well as foreign companies. Though the names suggest that they are set up for SMEs, these exchanges hardly follow the definition of SMEs in their respective jurisdictions. Also, many of them follow a sponsor-supervised market model, where sponsors or nominated advisors decide if the listing applicant is suitable to be listed or not, i.e., generally no quantitative entry criteria like track record on profitability or minimum paid-up capital or net worth, etc., are specified to be listed in these exchanges. Instead, they are designed as buyers beware markets for informed investors. SEBI has also designed the SME exchanges in a similar format with provisions for market making for the specified securities listed on the SME exchange. As is the case globally, certain relaxations are also provided to the issuers whose securities are listed on the SME exchange in comparison to the listing requirements in the main board, such as in BSE and NSE. In the case of India, which include 1. Publication of financial results on half-yearly basis instead of quarterly basis, making it available on their websites rather than publishing it. 2. Option of sending a statement containing the salient features of all the documents instead of sending a full annual report. 3. No continuous requirement of minimum number of shareholders, though at the time of IPO there needs to be a minimum of 50 investors, etc. 4. The existing eligibility norms like track record on profits, net worth or net tangible assets conditions, etc. have been fully relaxed for SMEs, as is the case globally. 5. However, no compromise has been made to corporate governance norms. Common facts about the national stock exchanges. Before the arrival of national-level stock exchanges, India was not having any exchange of national status. Better say there was no Indian stock market, but stock markets showing only regional pictures. Besides, the national stock exchanges did solve some major problems of stock market. We may also call their arrivals as part of the stock market reforms in India. The common features of these exchanges are 1. All are situated in Mumbai. 2. All do screen-based trading, SBT. 3. All have their trading terminals in the major cities of the country. 4. All are web-enabled. 5. All are limited liability companies. 6. The brokers registered here have no say in either the ownership or the management of the exchanges. 7. All are counted among the best and the most technology-equipped stock exchanges in the world. Players in the stock exchanges. Broker is a registered member of a stock exchange who buys or sells shares or securities on his client's behalf and charges a commission on the gross value of the deal. Such brokers are also known as commission brokers. Brokers who offer services such as investment advice, client's portfolio planning, credit when a client is buying on margin other than their traditional commission job are known as full-service brokers. In India, such brokers are just coming up. Jobber. A jobber is a broker's broker or one who specializes in specific securities catering to the need of other brokers. In India, also known as Tarwaniwala, in the BSE. A jobber is located at a particular trading post on the floor of the stock exchange and does buying and selling for small price differences, called the spread. He has no contact with the investing public. In the London Stock Exchange, he is called a market maker, while in the New York Stock Exchange, he is called a specialist. The Bombay Stock Exchange has made it mandatory for every company with a share capital of over 3 crore rupees to appoint jobbers or market makers if it seeks enlistment. Such an arrangement enables investors to buy and sell shares on the stock exchange, and thus liquidity increases. Market maker functions as an intermediary in the market ready to buy and sell securities. He simultaneously quotes two-way rates, like a jobber basically, with the only difference that he quotes two-way rates for buying and selling at the same time. On the floor of India's OTC, only market makers are allowed to play. In the money market of India, the Discount and Finance House of India, DFHI, is the chief market maker. Since he quotes the selling price while buying a particular share, he makes market for that share, hence such a name. The Nasdaq of the USA is a market maker's stock exchange where they are connected by the web-enabled trading terminals. SEBI. The regulator of Indian stock market, set up under the Security and Exchange Board of India Act 1992, as a non-statutory body set on 12 April 1988 through a government resolution in an effort to give the Indian stock market an organized structure, with its head office in Mumbai. Its initial paid-up capital was 50 crore rupees provided by the promoters, the IDBI, the IFCI, and the ICICI. The board of SEBI comprises 9 members excluding the chairman, 1 member each from the Ministries of Finance and Law, 1 member from the RBI, and 2 other members appointed by the central government. It has 4 full-time members, including the chairman. Main functions or powers of the board, as per the SEBI Act, 1992 are 1. Registering and stock exchanges, merchant banks, mutual funds, underwriters, registrars to the issues, brokers, sub-brokers, transfer agents and others. 2. Levying various fees and other charges, as 1% of the issue amount of every company issuing shares are kept by it as a caution money in the concerned stock exchange where the company is enlisted. 3. Promoting investor education. 4. Inspection and audit of stock exchanges and various intermediaries. 5. Performing other concerned functions as may be prescribed from time to time. Commodity trading. Commodity trading happens similar to stocks, shares, securities, debentures, bonds, trading in the stock market. However, commodities are actual physical goods such as corn, silver, gold, crude oil, etc. Futures are contracts for commodities that are traded at a futures exchange like the Chicago Board of Trade, CBOT. Futures contracts have expanded beyond just commodities. Now there are futures contracts on financial markets like foreign currencies, interest rates, etc. Commodity futures serve a great purpose in any economy. As we see in the case of agricultural commodity, their prices play a key role in determining the fortune of the agriculture and food processing industry in India. These prices undergo a large degree of fluctuation. Reasons for price fluctuation are crop failure, bad weather, demand-supply imbalance, etc. This fluctuation, in turn, leads to a price risk. This price risk is largely borne by the farmer and the industries where agricultural commodities are used as raw material. Commodity exchanges are associations that determine and enforce rule and set procedures for trading of commodities. The main objective of the exchange is to protect the participants from adverse movement in prices by facilitating futures trading in commodities. If the participants hedge themselves against this price risk, then they would be able to insulate themselves against the inherent price fluctuations associated with agricultural commodities. One of the methods of doing this would be by using commodity exchanges as a trading platform. Apart from hedging against price risk, a commodity exchange helps in production and procurement planning as one can buy in small lots. Further, as the exchange consists of various informed industry participants, price discovery is more efficient and discounts the local and global factors. Let us take a very simple example to understand how trading on commodity exchanges help industry participants. A farmer who is producing wheat can sell wheat futures on a commodity exchange. This will help him lock in a sale price of a specified quantity of wheat at a future date. Hence, the farmer would now be able to get an assured price for his produce in future, and any decline in the price of wheat would not impact his earnings. On the other hand, a user industry, example, a flour mill, could purchase the wheat futures from the exchange. Hence, the flour mill would now be able to fix its future purchase cost for a specified quantity of wheat. Therefore, Any increase in the price of wheat in future would not impact its cost of production. As per SEBI, April 2019, there are 91 commodities notified for future trading in the country. In wake of extra volatility and high speculation, at times, trading in some of them is suspended also. There are 21 national and regional commodity exchanges in the country. The 6 national exchanges are 1. National Commodity and Derivatives Exchange, NCDEX, 2. National Multi-Commodity Exchange, NMC, 3. Multi-Commodity Exchange, MCX, 4. Indian Commodity Exchange, ICX, 5. ACE Derivatives and Commodity Exchange, ACE. 6. Universal Commodity Exchange, UCE. Improvements in warehousing. The government has been incentivizing private investments in warehousing through various subsidies and tax SOPs. Under the purview of the Warehousing Development and Regulatory Authority, WDRA, a new breed of storage facilities has come up which are scientifically developed, supported by value-added services such as weighing, testing, certification, and even come equipped with 24/7 physical security, with a number of them sport CCTV-led remote monitoring facilities from a central location. The most interesting feature of these modern-day warehouse is that they possess an IT backbone which enables real-time stock updates. As these warehouses undergo regular physical audits, both by internal and external teams, the physical integrity of the stock, both in terms of quality and quantity, can easily be ascertained at any point of time. These state-of-the-art, high-tech warehouses enable the stakeholders to gain finance using electronic negotiable warehouse receipts, ENWRs. Regulation and reform. While the FMC, Forward Markets Commission, regulated the commodity markets since 1952, it was perceived as lacking the power to control wild fluctuations in prices and other irregularities. Accordingly, in 2015, FMC was merged with SEBI, with reputation of being superior in terms of surveillance, risk monitoring and enforcement mechanisms, and a more robust regulatory body for the sector. Subsequently, SEBI has initiated several reforms measures, allowing stock brokers to deal in commodity derivatives, common broking businesses for equities and commodities, permitting the NSE and BSE to commence commodity trading, allowing the FPIs to participate in commodity derivatives contracts traded in stock exchanges subject to certain stipulations, allowing the Category 3 Alternative Investment Funds, AIFs, to trade in commodity markets. As per the experts, India's commodity trading market is at the cusp of transformation as multiple changes are taking place in the related areas such as infrastructure, logistics, electronic warehousing, transportation, etc. Spot exchanges. In India, spot exchanges refer to electronic trading platforms which facilitate purchase and sale of specified commodities, including agricultural commodities, metals and bullion by providing spot delivery contracts in these commodities. This market segment functions like the equity segment in the main stock exchanges. Alternatively, this can be considered as a guaranteed direct marketing by sellers of the commodities. Spot exchanges leverage on the latest technology available in the stock exchange framework for the trading of goods. This is an innovative Indian experiment in the trading of goods and is distinct from what is commonly known as commodity exchanges, which trade in futures contracts in commodities. Spot exchange has been defined by the Warehousing Development and Regulatory Authority, Electronic Warehouse Receipts, Regulations, 2011 as a body corporate incorporated under the Companies Act, 1956 and engaged in assisting, regulating or controlling the business of trading in electronic warehouse receipts. However, present-day spot exchange deals not just with warehouse receipts. This is an electronic market where a farmer or a trader can discover the prices of commodities on a national level and can buy or sell goods immediately, i.e., on the spot, to anyone across the country. All contracts on the exchange are compulsory delivery contracts. It means that all outstanding positions at the end of the day are marked for delivery, which implies that seller has to give delivery and buyer has to take the delivery. The facilities provided by the spot exchange, like a normal stock exchange, include clearing and settlement of trades. Trades are settled on guaranteed basis, i.e., in case of default by any person, exchange arranges for the payment of money or good, and the exchange collects various margin payments to ensure this. The exchange also offers various other services, such as quality certification, warehousing, warehouse receipt financing, etc. Spot exchanges in India. At present, there are 4 spot exchanges operating in the country. 1. The National Spot Exchange Limited, NSEL, set up in 2008, is a national-level commodity spot exchange promoted by the Financial Technologies India Ltd, FTIL, and National Agricultural Cooperative Marketing Federation of India Limited, NAFT. After the FTIL was found involved in irregularities, the FMC, Forward Market Commission, by end March 2014 asked it to exit the spot exchange. 2. NCDX Spot Exchange Ltd, established in October 2006 by NSE. 3. Reliance Spot Exchange Limited, are next. 4. Indian Bullion Spot Exchange Limited, an online over-the-counter spot exchange. Advantages of spot exchanges. Spot exchange provides various advantages over the traditional way of trading in commodities. 1. Efficient price determination, as price is determined by a wider cross-section of people from across the country, unlike the traditional mandis where price discovery for commodities used to happen only through local participation. 2. Ensures transparency in price discovery. Anonymity ensures convergence of different price perceptions, as the buyer or seller merely expresses their desire to trade without even meeting directly. 3. Ensures participation in large numbers by farmers, traders and processors across the country, and eliminate the possibility of cartelization and other such unhealthy practices prevalent in the commodity markets. 4. It brings in some best practices in commodity trading like system of grading for quality, creating network of warehouse with assaying facilities, facilitating trading in relatively smaller quantities, lower transaction cost, etc. 5. Bank finance available against the goods in the warehouse on easier terms improves holding capacity and can actually incentivize farm production and hence reduce rural poverty. 6. Since the trades are guaranteed by the exchange, counterparty risk is avoided. Raising capital in the primary market. There are 3 ways in which a company raises capital in the primary market. Public issue or public offer is open for all Indian citizens, the most broad-based method of raising capital, and the most prestigious, too. The Reliance Industries Limited is the biggest company of India in this category. Rights issue raising capital from the existing shareholders of a company. It means it is a preferential kind of issue restricted to a certain category of the public only. Private placement raising capital by selling shares to a select group of investors, usually financial institutions, FIs, but may be to individuals also. This is done through a process of direct negotiations, completely opposite to the public issue. The advantage of this route is the substantial saving a share issuing company makes on marketing expenses, but the risk of shifting loyalties of the investors in this route is also the highest. Recent times have seen such capital raising by many companies privately placing their shares to the foreign institutional investors, FIIs, as a route to source foreign exchange in India, and that too quickly. Important terms of stock market. Short selling. Sale of a share which is not owned. This is done by someone after borrowing shares from stockbrokers promising to replace them at a future date on the hope, speculation, that the price will fall by then. He fetches profit if price of the share really fell down by the future date of replacement and sustains a loss if the price increased. Recently, short selling has been allowed in India by SEBI. Bear and bull. A person who speculates share prices to fall in future and so sells his shares and earns profit is a bear. He earns profit out of a falling market. Basically, here he is short selling the shares. Opposite to bear, bull is a person who speculates share prices to go up in future so either stops selling the select group of shares for that time to be reached. He is basically taking long position on those shares or starts purchasing that select group of shares. Thus, a bear increases the number of shares in a stock market activating a general fall in the index, a bearish market. Opposite to it, a bull creates a scarcity of shares in the stock market activating a general rise in the share prices and the index, a bullish market. Brokers play as a bear for some stocks and as a bull for some other stocks. While a bear broker is a non-entity, a bull is remembered for long time to come. Harshad Mehta was known as the Great Bull. Book building. A provision allowed by SEBI to all initial public offers, IPOs, in which individual investors are reserved and allotted shares by the company. But the issuer has to disclose the price at which shares have been allotted, the size of the issue, and the number of shares offered to the public. IPO. Initial public offer, IPO, is an event of share issuing when a company comes up with its share or securities issued for the first time. Price band. A process of public issue where the company gives a price range, known as price band, and it is left upon the share applicants to quote their prices on it, the highest bidders getting the shares. This is a variant of share issue at premium, but considered a safer choice. Scrip share. A share given to the existing shareholders without any charge, also known as bonus share. Sweat share. A share given to the employees of the company without any charge. Rolling settlement. An important reform measure started in the Indian stock market in mid-2001 under which all commitments of sale and purchase result into payment or delivery at the end of the X days later, where X stands for 5 days. Some shares have X as 1, 2 or 3 days too. Today, all shares are covered under this provision. Badla. When the buyers want postponement of the transaction, in Western world called contango. Und badla. When the sellers want postponement of the transaction, also known as the reverse badla or backwardation. Futures. A trading allowed in shares where a future price is quoted for the shares and the payment and delivery takes place on the predetermined dates. Depositories. Started in 1996 under which stocks are converted into paperless form, dematerialization of shares, shortly known as the demat. At present, two public sector depositories, Mumbai, are functioning in India set up under the Depositories Act, 1996, 1. NSDL, National Securities Depositories Limited. 2. CDSL, Central Depositories Services Limited. Spread. The difference between the buying and selling prices of a share is called spread. Higher the liquidity of a share, lower its spread, and vice versa. Also known as jobber's turn or margin or haircut. Curb dealings. The transactions of stocks would take place outside the stock exchanges, unofficially, and take place after the normal trading hours. NSCC. The National Securities Clearing Corporation, NSCC, a public sector company set up in 1996, takes the counterparty risk of all transactions done at the NSE just as an intermediary guarantees all trades. Demutualization. A process started 2002 by SEBI under which ownership, management and trading membership was to be segregated from each other. No broker was to be on the board of directors or an office bearer in a stock exchange. This has been done in the case of all stock exchanges except 3 regional stock exchanges, RSEs, in India. Authorized capital. The limits up to which shares can be issued by a company, also known as the nominal or registered capital. This is fixed in the Memorandum of Association, MOA, and the Article of Association, AOA, of a company as required by the Companies Act, law. Paid-up capital. The part of the authorized capital of a company that has actually been paid by shareholders. A difference may arise because all shares authorized might not be issued or issued shares are only partly paid up. Subscribed capital. The amount actually paid by the shareholders or have been committed by them for contribution. Issued capital. The amount which is sought by a company to be raised by issuing shares, which cannot exceed the authorized capital of the company. Greenshoe option. A provision under which a company issuing shares for the first time is allowed to sell some additional shares to the public, usually 15%, is also known as overallotment provision. It gets its name from the first company, Greenshoe Company, USA, which was allowed such an option. Penny stocks. The share which remains low-priced at a stock exchange for a comparatively longer period. Speculators may start hoarding them for hefty margins. This was seen in India in mid-2006. And since such stocks get hoarded, ultimately their market prices increase. The speculators earn profit after offloading, selling these shares at high prices, and others who purchase these shares ultimately might fetch huge losses because price rise of these stocks are unintentional or each intentional manipulation and nothing else. ESOP. The Employee Stock Ownership Plan, ESOP, enables a foreign company to offer its shares to employees overseas. It was allowed in India, February 2005, provided that the MNC has minimum 51% holding in its Indian company. Earlier, a permission from the RBI was required for such an option. SBT. Screen-based trading, SBT, is trading of stock based on the electronic medium, i.e., with the help of computer monitor, internet, etc. First such trading was introduced in New York in 1972 by the bond broker Cantor Fitzgerald. India introduced it in 1989 at the OTC. Now it is carried out at all exchanges. OFCDs. Debentures are the debt instruments which may be issued by a listed or non-listed firm to raise funds in a security market. They are of many types, viz., redeemable, non-redeemable, partially convertible, and fully convertible. In case of fully convertible debentures an option, that is why the name OFCDs, i.e., optionally fully convertible debentures, is given to the debenture holders who may wish to convert their OFCDs into shares after expiry of the period fixed by the debenture issuing firm, known as lock-in period. But the rate will be decided by the company. Example, how many shares against how many debentures. For debenture holders, the option to convert debenture into shares is profitable and/or safer once either of the following situations are correct. 1. The firm is likely to make high profit, so the shareholder can earn higher dividend. Or 2. Firm's share price is likely to rise in the share market. Profit can be made by selling shares. But suppose the firm has weak balance sheet, going bankrupt, then it is better to keep hold on the debenture rather than converting them into shares, because when a company is liquidated, i.e., its assets sold off, the debenture holders get primacy over shareholders in payment. It means OFCD is a bit tricky thing and is the only suitable route to invest in the security market for the investors who have some knowledge and understanding of share prices, company performance, etc. Recently, the OFCDs issued by Sahara, an NBFC under regulatory control of the RBI, were in news due to some irregularities. It was a simple case of certain loopholes in the regulation of OFCDs and some violations by Sahara. 1. Actually, an OFCD issue process has to be completed within 10 working days. Sahara continued for over 2 years. 2. If the OFCD is being issued through the private placement route, only 50 individuals or institutions can subscribe to it. Sahara issued it to over 23 million people and raised over 24,000 crores rupees. Such a tricky instruments being issued to novice public was a clear case of financial irregularities. 3. Unlisted companies do not come under the regulatory control of SEBI. In place, they are regulated by the Ministry of Corporate Affairs. Both the Sahara firms which issued OFCDs are unlisted. But SEBI contended that it can regulate even an unlisted firm if it issues OFCD, as the SEBI Act 1992 contains the term OFCDs. There was really some regulatory confusion. This is why the government added a clause in the Companies Amendment Act 2012 which gives SEBI undisputed jurisdiction over any investment scheme involving more than 50 investors, whether the company is listed or unlisted. Meanwhile, Sahara has been ordered to return the total capital it raised through OFCDs with an interest of 15% per annum. Derivatives. Derivative is a product whose value is derived from the value of one or more basic variables, called bases, underlying asset, index or reference rate, in a contractual manner. The underlying asset can be equity, forex, commodity, or any other asset. For example, wheat farmers may wish to sell their harvest at a future date to eliminate the risk of a change in prices by that date. Such a transaction is an example of a derivative. The price of this derivative is driven by the spot price of wheat, which is the underlying. In the Indian context, the Securities Contracts Regulation Act 1956 (SCRA) defines derivative to include 1. A security derived from a debt instrument, share, loan whether secured or unsecured, risk instrument or contract for differences or any other form of security. 2. A contract, which derives its value from the prices or index of prices of underlying securities. Derivatives are securities under the SCRA, and hence the trading of derivatives is governed by the regulatory framework under the SCRA and are allowed to be traded on the floors of the stock exchanges. Indian Depository Receipts, IDRs. As per the definition given in the Companies Issue of Indian Depository Receipts, Rules, 2004, IDR is an instrument in the form of a depository receipt created by the Indian Depository in India against the underlying equity shares of the issuing company. In an IDR, foreign companies would issue shares to an Indian depository, say the National Security Depository Limited, NSDL, which would in turn issue depository receipts to investors in India. The actual shares underlying IDRs would be held by an overseas custodian, which shall authorize the Indian depository to issue of IDRs. Just try to understand in a simple way. An IDR is a mechanism that allows investors in India to invest in listed foreign companies, including multinational companies, in Indian rupees. IDRs give the holder the opportunity to hold an interest in equity shares in an overseas company. IDRs are denominated in Indian rupees and issued by a domestic depository in India. They can be listed on any Indian stock exchange. Anybody who can invest in an IPO, initial public offer, is or are eligible to invest in IDRs. In other words, what ADRs or GDRs are for investors abroad with respect to Indian companies, IDRs are for Indian investors with respect to foreign companies. Shares at par and at premium. An ordinary share in India, in general, is said to have a par value, face value, of 10 rupees, though some shares issued earlier still carry a par value of 100 rupees. Par value implies the value at which a share is originally recorded in the balance sheet as equity capital. This is the same as ordinary share capital. SEBI guidelines for public issues by new companies established by individual promoters and entrepreneurs require all new companies to offer their shares to the public at par, i.e., at 10 rupees. However, a new company set up by existing companies, and of course existing companies themselves, with a track record of at least 5 years of consistent profitability, are allowed to issue shares at a premium. When a company issues shares at a premium, it is able to raise the required amount of capital from the public by issuing a fewer number of shares. For example, while a new company promoted by first-time entrepreneurs intending to raise, say, 1 crore rupees, has to offer 10 lakh ordinary shares at 10 rupees each, at par, an existing company may raise the same amount by offering only 2 lakh shares at 50 rupees each, close to the market value of its shares. The latter is said to have issued its share at a subscription price of 50 rupees, 10 rupees in the case of the former company, at a premium of 40 rupees, being the excess of subscription price over par value. In such a situation in India, the company's books of accounts will show 10 rupees towards share capital account and 40 rupees towards share premium account. It means that the higher the premium, the fewer will be the number of shares a company will have to service. For this very reason, following the policy of free pricing of issues in 1993, many companies came out with issues at prices so high that in many cases they were higher than their market prices, leading to undersubscription of such issues. The companies are, however, learning fast about the pitfalls of high pricing of shares, and it is only a matter of time before the issue prices become more realistic. Foreign financial investment. India opened capital market for foreign portfolio investment or foreign institutional investment, FPI or FII. In 1994, at present, there are 9,136 such firms registered with the SEBI. Today, they are one of the biggest drivers of India's financial markets and have invested around 12.51 trillion rupees, $171.81 billion in India between FY 0 to 18. Highly developed primary and secondary markets have attracted FIIs or FPIs to the country. Their investments are regulated by SEBI, while the ceilings on such investments are maintained by the RBI. Almost all types of them are today active in the market: hedge funds, foreign mutual fund, sovereign wealth funds, pension funds, trusts, asset management companies, endowments, university funds, etc. Major regulatory initiatives. SEBI announced several regulatory changes to encourage safe and higher foreign portfolio investment in the country during 2018 to 19. Direct overseas listing of Indian companies allowed. The KYC, know your client, requirement relax. Foreign entities allowed to participate in the commodity derivatives. NRIs allowed to invest through FPI route. The timeline for public issue of debt securities reduced to 6 days from 12 days. FPIs allowed to invest up to 25% in Category 3 Alternative Investment Funds, AIF. FPIs allowed to invest in the Real Estate Investment Trusts, REITs, and Infrastructure Investment Trust, InvITs. Today, India is being viewed as a potential opportunity by investors, with the economy having the capacity to grow tremendously. Buoyed by strong support from the government, FII investments have been strong and are expected to grow in the coming times. Classification. The FPIs have been classified by the SEBI into 3 broad categories, namely: Category I, the government entities or institutions investing in Indian security market on behalf of the central bank. Category 2, the financial institutions, mutual funds, etc., which duly regulated in the countries of their origin. Category 3, the financial institutions, which do not fall either of the above given categories. Angel investor. A new term in India's financial market, introduced in the Union Budget 2013-14, which announced that SEBI will soon prescribe the provisions by which the angel investor can be recognized as Category I AIF venture capital funds. Angel investor is an investor who provides financial backing to entrepreneurs for starting their business. Angel investors are usually found among an entrepreneur's family and friends, but they may be from outside also. The capital they provide can be a one-time injection of seed money or ongoing support to carry the company through difficult times. In exchange, they may like owning share in the business or provide capital as loan. In case of a loan, they lend at more favorable terms than other lenders, as they are usually investing in the person rather than the viability of the business. Other than investable capital, these investors provide technical advices and also help the startup business with their lucrative contacts. They are focused on helping the business succeed rather than reaping a huge profit from their investment. Angel investors are essentially the exact opposite of a venture capitalist in their intention, who has high profit prospects as their prime focus. But in one sense, both an angel investor and a venture investor serve the same purpose for the entrepreneur who is in dire need of investable capital. QFI scheme. In the budget 2011-12, the government, for the first time, permitted qualified foreign investors, QFIs, who meet the Know Your Customer KYC, norms to invest directly in Indian mutual funds. In January 2012, the government expanded this scheme to allow QFIs to directly invest in Indian equity markets. Taking the scheme forward, as announced in Budget 2012-13, QFIs have also been permitted to invest in corporate debt securities, CDSs, and MF debt schemes subject to a total overall ceiling of $1 billion. In May 2012, QFIs were allowed to open individual non-interest-bearing rupee bank accounts with authorized dealer banks in India for receiving funds and making payment for transactions in securities they are eligible to invest in. In June 2012, the definition of QFI was expanded to include residents of the member countries of the Gulf Cooperation Council, GCC, and European Commission, EC, as the GCC and EC are members of the Financial Action Task Force, FATF. The speedier moves in the area of promoting higher foreign investment, FIs, in India should be seen in the light of two broad perspectives, viz. 1. India's rising current account deficit, which crossed an all-time high of 6.7% by March 2013, which is creating heavy drain of foreign exchange, and 2. The objective of attracting more FIs while the Western economies are under the spell of recession, cashing in the opportunity. RFPIs. In March 2014, the RBI simplified foreign portfolio investment norms by putting in place an easier registration process and operating framework with an aim to attract inflows. From now onwards, the portfolio investor registered in accordance with the SEBI guidelines shall be called Registered Foreign Portfolio Investor, RFPI. The existing portfolio investor class, namely Foreign Institutional Investor, FII, and Qualified Foreign Investor, QFI, registered with SEBI shall be subsumed under it. The new guidelines for RFPIs are as given below. 1. They may purchase and sell shares and convertible debentures of Indian companies through a registered broker on recognized stock exchanges in India, as well as purchase shares and convertible debentures, which are offered to public in terms of relevant SEBI guidelines. 2. Such investors can acquire shares or convertible debentures in any bid for or acquisition of securities in response to an offer for disinvestment of shares made by the central government or any state government. 3. These entities would be eligible to invest in government securities and corporate debt, subject to limits specified by the RBI and SEBI from time to time. 4. Such investors would be permitted to trade in all exchange-traded derivative contracts on the stock exchanges, subject to the position limits as specified by SEBI from time to time. 5. RFPI may offer cash or foreign sovereign securities with AA rating or corporate bonds or domestic government securities as collateral to the recognized stock exchanges for their transactions in cash as well as derivative segment of the market. All investments made by that FIIs or QFIs in accordance with the regulations prior to registration as RFPI shall continue to be valid and taken into account for computation of aggregate limit. Participatory notes, PNs. A participatory note, PN or P-note, in the Indian context, in essence, is a derivative instrument issued in foreign jurisdictions by SEBI registered FII against Indian securities. The Indian security instrument may be equity, debt, derivatives or may even be an index. PNs are also known as overseas derivative instruments, equity-linked notes, capped return notes, and participating return notes, etc. The investor in PN does not own the underlying Indian security, which is held by the FII who issues the PN. Thus, The investors in PNs derive the economic benefits of investing in the security without actually holding it. They benefit from fluctuations in the price of the underlying security since the value of the PN is linked with the value of the underlying Indian security. The PN holder also does not enjoy any voting rights in relation to security or shares referenced by the PN. Reasons for the popularity of PNs. The reasons why PNs became such a popular route for foreign investors to invest in the Indian security market may be understood through the following points. 1. One of the primary reasons for the emergence of the PN, an offshore derivative instrument, i.e., an ODI, is the restrictions on foreign investments. For example, a foreign investor intending to make portfolio investments in India was required to seek FII registration, for which he is required to meet certain eligibility criteria. Lack of full capital account convertibility further enhances the entry barriers from the perspective of a foreign investor. However, since January 2012, the Indian government has taken a decision to give direct access to such prospective foreign individual investors who were hitherto banned to invest in equity of Indian companies. 2. The offshore derivative market allows investors to gain exposure to the local shares without incurring the time and costs involved in investing directly. In return, the foreign investor pays the PN issuer a certain basis points of the value of PNs traded by him as costs. For instance, directly investing in the Indian securities markets as an FII has significant cost and time implications for the foreign investor. Apart from seeking FII registration, he is required to establish a domestic broker relationship, a custodian bank relationship, deal in foreign exchange and bear exchange rate fluctuation risk, pay domestic taxes and/or filing tax return, obtain or maintain an investment identity, etc. These investors would rather look for derivatives alternatives to gain a cost-effective exposure to the relevant market. 3. Besides reducing transactions costs, PNs also provide customized tools to manage risk, lower financing costs, and enhance portfolio yields. For instance, PNs can also be designed for longer maturities than are generally available for exchange-traded derivative. 4. PNs also offer an important hedging tool to a foreign investor already registered as an FII. For example, an FII may wish to obtain long exposure to a particular Indian security. The FII can hedge the downside exposure to the listed security already purchased by purchasing a cash-settled put option. Although the Indian exchanges offer options contract, these contracts have a maximum life period of 3 months, beyond which the FII shall have to roll over its positions, i.e., purchase a fresh option contract. Alternatively, it can avail of a PN, which can be customized to cater to its hedging requirements. 5. Potential investors who would like to take direct Indian exposure in future may make initial investments through the PN route so as to get a flavor of future anticipated returns. 6. Further, trading in ODI or PNs gives an opportunity to offshore entities to have a commission-based business model. This route provides ease to subscribers as it bypasses the direct route, which may be resource-heavy for them. 7. And lastly, it was a highly safe and lucrative route to invest the unaccounted, even illegal money into the Indian security market for huge profits during the booming period. Experts even imagined that it may be allowing the black money of India, stashed away from India through Hawala kind of illegal channels and deposited in the tax havens of the world in Swiss bank kind of financial institutions, to get invested back in the market. Again, Terrorist organizations might have been using this route too. PNs are thus issued to provide access to a set of foreign investors who intend to reduce their overall costs and the time involved in making investments in India. In other words, the attraction of investing in PNs is primarily one of efficiency, from an infrastructure and time perspective, for which they are willing to forego certain benefits of directly holding the local securities, for example, title and voting rights, whilst also assuming other risks. Regulation of PNs. PNs are market instruments that are created and traded overseas. Hence, Indian regulators cannot ban the issue of PNs. However, they can regulate it, as SEBI does, when a PN is traded on an overseas exchange. The regulator in that jurisdiction would be the authority to regulate that trade. PNs have been used by FIIs since FIIs were permitted to invest in the securities market. 1994, they were not specifically dealt with under the regulations until 2003. According to the SEBI regulation, 2004, and further amended in 2008, with the objective of tightening regulations in this regard. 1. PNs can be issued only to those entities which are regulated by the relevant regulatory authority in countries of their incorporation and are subject to compliance of Know Your Client (KYC) norms. 2. Downstream issuance or transfer of the instruments can also be made only to a regulated entity. 3. Further, the FIIs who issue PNs against underlying Indian securities are required to report the issued and outstanding PNs to SEBI in a prescribed format. 4. In addition, SEBI can call for any information from FIIs concerning offshore derivative instruments, ODIs, issued by it. 5. In order to monitor the investment through these instruments, SEBI on 31 October 2001 advised FIIs to submit information regarding issuance of derivative instruments by them on a monthly basis. These reports require the communication of details such as name and constitution of the subscribers to PNs, their location, nature of Indian underlying securities, etc. 6. FIIs cannot issue PNs to non-resident Indians, NRIs, and those issuing PNs are required to give an undertaking to the effect. 7. SEBI has also mandated that QFIs, qualified foreign investors, the recently allowed foreign investor class, shall not issue PNs. SEBI in consultation with the government had decided in October 2007 to place certain restrictions on the issue of PNs by FIIs and their subaccounts. This decision was taken with a view to moderate the surge in foreign capital inflows into the country and to address the Know Your Client concerns for PN holders. However, it was found that such restrictions were ineffective. Therefore, SEBI in October 2008 reviewed its earlier decision and decided to remove these restrictions in the light of the above factors. Rather, more attention is given to effective disclosures. As per SEBI decision of October 2013, the Category 3 FIIs are not allowed to issue PNs. The concerns related to PNs being derivative instruments and freely tradable, PNs can be easily transferred, creating multiple layers, thereby obfuscating the real beneficial owner. It is in this respect that concerns about the identity of ultimate beneficial owner and the source of funds arises. For the reason that such instruments are issued outside of India, these transactions are outside the purview of SEBI's surveillance, and it is the FII which acts as mini exchange overseas. The actual transactions in the underlying securities are executed by the FIIs only at its discretion, as and when necessary, and there is no one-to-one correspondence between transactions in the underlying instruments and issuance of PNs. The ex-post reporting requirement enjoined upon the FII in respect of PNs on a monthly basis effectively keeps the transactions in PNs out of the real-time market surveillance mechanism and beyond the enforceability jurisdiction of SEBI. There are also concerns that some of the money coming into the market via PNs could be the unaccounted wealth camouflaged under the guise of FII investment. However, this has not been proved so far. SEBI has indeed been successful in taking action against the FIIs who were non-compliant and those who had misreported offshore derivatives, as happened when SEBI took actions against two FIIs, Barclays in December 2009 and Société Générale in January 2010. At present, PNs are issued by large financial sector conglomerates which not only have strong presence in the global investment banking arena, but also have asset management arms which invest across a number of securities markets globally. These entities are originally incorporated in well-regulated and developed jurisdictions like the US, UK, etc. Further, these entities also possess the financial wherewithal to issue PNs, complemented by skilled personnel who are adept at risk management and financial engineering activities. International situation. PN-like products are not necessarily used to invest in restricted markets, but also reported to be available in the open developed or advanced economies like Japan, Hong Kong, Singapore, Australia, the USA and UK. In response to market manipulation concerns, in December 1999, Taiwan Securities and Futures Commission had amended its FII regulations to require periodic disclosure by FIIs of all offshore derivative activities linked to local shares, but this requirement was subsequently removed in June 2000, as the Ashok Lahiri Committee report says. China's Securities Regulatory Commission requires entities to file reports related to these products with minimal reporting requirements that emphasize only on the quota utilized by them. Other Asian countries like Hong Kong, Singapore, and Japan have reportedly no restrictions or requirements on PNs. Malaysia, Indonesia, and Philippines, which are restricted markets though, are having no reporting requirements in this regard. Hedge fund. This term has come up from another term, hedging, a process by which businesses insulate themselves from the risk of price changes. Hedge funds are the lot of investable, free-floating capital which move very swiftly towards the more profitable sectors of an economy. At present, such funds easily move from the stock market of one economy to the other, away from the low profit fetching to high profit fetching ones. As stock markets fall and rise, such funds change markets accordingly. By nature, they are temporary. The period for which they continue flowing into an economy, there is naturally a boom time. But when they quit for a more attractive economy, the same economy might not be able to manage the accelerated foreign currency outflow, and there are chances of imminent foreign currency crisis. This has been in news for the last 2 years in India, where stock market has been in boom, riding on the FII's inflow via participatory notes, PNs. ECB policy. A prospective borrower can access external commercial borrowings, ECBs, under two routes, namely the automatic route and the approval route. ECBs not covered under the automatic route are considered on case-by-case basis by the RBI under the approval route. The High-Level Committee on ECB took a number of decisions in September 2011 to expand the scope of ECBs, which include 1. High net worth individuals, HNIs, who fulfill the criteria prescribed by SEBI can invest in IDFs. 2. IFCs have been included as eligible issuers for FII investment in the corporate bonds long-term infra category. 3. ECB would be permitted for refinancing of rupee loans of infrastructure projects on the condition that at least 25% of such ECBs shall be used for repayment of the said rupee loan and 75% invested in new projects in the infrastructure sector, but only under the approval route. 4. Refinancing of buyers or suppliers' credit through ECBs for the purchase of capital goods by companies in the infrastructure sector was approved. This would also be permitted only under the approval route. 5. ECBs for interest during construction, IDC, that accumulates on a loan during the project execution phase for companies in the infrastructure sector would be permitted. This would be subject to the condition that the IDC is capitalized and is part of the project cost. 6. Renminbi, RMB, the Chinese currency, was approved as an acceptable currency for raising ECBs subject to or limit of $1 billion within the existing ECB ceiling, allowed only through the approval route. 7. The existing ECB limits under the automatic route were enhanced from $750 million for eligible corporates. For borrowers in the services sector, the limit has been enhanced from $200 million, and for NGOs engaged in microfinance activities from the existing $10 million. Till April 2020, the norms for ECB were further simplified and streamlined by the government. Major steps taken in this regard were as given below. 1. Enhancing the limit for refinancing rupee loans through ECB from 25% to 40% for Indian companies in the power sector. 2. Allowing ECB for capital expenditure on the maintenance and operation of toll systems for roads and highways so long as they are a part of the original project subject to certain conditions, and also for low-cost housing projects. 3. Reducing the withholding tax from 20% to 5% for a period of 3 years, July 2012 to June 2015, on interest payments on ECBs. 4. Introducing a new ECB scheme of $10 billion for companies in the manufacturing and infrastructure sectors. 5. Permitting the Small Industries Development Bank, SIDB, as an eligible borrower for accessing ECB for on lending to the micro, small and medium enterprises, MSMEs, and 6. Permitting the National Housing Bank, NHB, or housing finance companies to avail themselves of ECBs for financing prospective owners of low-cost or affordable housing units. 7. In December 2015, the RBI announced a new ECB framework which was more attuned to the current economic and business environment. From regulatory perspective, now, the ECBs will have 3 main clear-cut categories: A. Medium-term foreign currency denominated ECB, B. Long-term foreign currency denominated ECB, with minimum average maturity of 10 years, and C. Indian rupee denominated ECB. The new lenders comprise overseas regulated financial institutions, sovereign wealth funds, pension funds, insurance companies, etc., and has an exhaustive list of permissible end users with only a small negative list for long-term foreign currency denominated ECB and INR denominated ECB. 8. In order to facilitate rupee denominated borrowing from overseas, the government decided, December 2015, to put in place a framework for issuance of rupee denominated overseas bonds. Such bonds have got a popular tag of the masala bonds. These bonds will have minimum maturity of 5 years. These bonds cannot be issued for real estate and capital markets sectors. Withholding tax of 5% will be applicable on interest income from these bonds, but the capital gains arising in case of appreciation of the rupee will be exempted from tax. Credit Default Swap (CDS). CDS is in operation in India since October 2011, launched in only corporate bonds. The eligible participants are commercial banks, primary dealers, NBFCs, insurance companies, and mutual funds. CDS is a credit derivative transaction in which two parties enter into an agreement whereby one party, called as the protection buyer, pays the other party, called as the protection seller, periodic payments for the specified life of the agreement. The protection seller makes no payment unless a credit event relating to a predetermined reference asset occurs. If such an event occurs, it triggers the protection seller's settlement obligation, which can be either cash or physical. India follows physical settlement. It means CDS is a credit derivative that can be used to transfer credit risk from the investor exposed to the risk, called protection buyer, to an investor willing to take risk, called protection seller. It operates like an insurance policy. In an insurance policy, the insurance firm pays the loss amount to the insured party. Similarly, the buyer of the CDS, the bank or institution that has invested in a corporate bond issue, seeks to mitigate the losses it may suffer on account of a default by the bond issuer. Credit default swaps allow one party to buy protection from another party for losses that might be incurred as a result of default by a specified reference instrument, a bond issue in India. The buyer of protection pays a premium to the seller, and the seller of protection agrees to compensate the buyer for losses incurred upon the occurrence of any one of the several specified credit events. Thus, CDS offers the buyer a chance to transfer the credit risk of financial assets to the seller without actually transferring ownership of the assets themselves. Let us try to understand it by an example. Suppose Punjab National Bank (PNB) invests in 150 crore rupees bond issued by TISCO. If PNB wishes to hedge losses that may arise from a default of TISCO, then PNB may buy a credit default swap from a financial institute, suppose Templeton. PNB will pay fixed periodic payments to Templeton in exchange for default protection, just like premium of an insurance policy. CDS can be used for different purposes in a financial system, viz. 1. Protection buyers can use it to hedge their credit exposure, while protection sellers can use it to participate in credit markets without actually owning assets. 2. The protection buyer can transfer credit risk on an entity without transferring the underlying instrument, reap regular benefit in terms of lower capital charge, seek reduction of specific concentrations in credit portfolio, and go short on credit risk. 3. The protection seller will be able to diversify his portfolio, create exposure to a particular credit, have access to an asset which may not otherwise be available, and increase the yield on his portfolio. 4. Banks can use it to transfer risk to other risk takers, create capital for more lending. 5. Distribute risk widely throughout the system and prevent concentrations of risk. Some analysts have serious apprehensions about CDS. George Akerlof, Nobel Prize-winning economist, in 1993, predicted that the next meltdown will be caused by CDS. In 2003, investment legend Warren Buffett called them as weapons of mass destruction. The former US Federal Reserve Chairman Alan Greenspan, who betted big on CDS, said after the subprime crisis that CDS are dangerous. A leading US weekly, The Newsweek, described CDS, the monster that ate Wall Street. Many Indian experts had the opinion that CDS will not stabilize the economy, rather could lead to destabilization. CDS contracts are dangerous because they can be manipulated for mischief. It's all about the insurable interest, which is never there, as it is used for speculation. A derivative that amounts to an insurance contract with no insurable interest is bad. But do the speculators have insurable interest? No, they don't have any. The US subprime crisis was a fallout of such CDS contracts, one defaulting and another claiming the protection, finally resulting into the defaulter of the insuring company. Overnight, the biggest US insurance giant, AIG, went bankrupt. So happened with many US banks also. The most damaging aspect of CDS is that the credit risk of one country or region gets exported to another country or region very smoothly and silently. Thus, there is a serious chance of contagion effect. Suppose there are defaulters there, the thing which happened during the US subprime crisis. Securitization. This is the process of issuing marketable securities backed by a pool of existing assets such as auto or home loans. After an asset is converted into a marketable security, it is sold to an investor who then receives interest and principal out of the cash flow generated from servicing of the loan. Financial institutions such as NBFCs and microfinance companies convert their loans into marketable securities and sell them to investors. This helps them get liquid cash out of assets that otherwise would be stuck on their balance sheets. Global experience shows that if the value of the underlying asset falls, then securitized assets lose value, as it had happened during the US subprime crisis. Home loans against which securitized assets were sold to insurance companies and banks lost value, which in turn resulted in a crisis. To prevent such crises, the RBI has taken some precautionary steps in this regard. It has asked companies to hold securities for a certain minimum period. 1. While NBFCs need to keep assets for 6 months, a minimum retention requirement of 5 to 10% to ensure that they have a continuing stake in the performance of securitized assets. 2. Microfinance institutions, MFIs, need to hold them for 3 months. Since it was allowed in India by the RBI, it has been in news whether the securitizations trusts will need to pay tax on it. Meanwhile, the government in 2015 cleared the air on the issue. There should not be any additional income tax if the income distributed by the trust is received by a person who is exempted from tax. This is expected to bring back mutual funds into the securitization market. Corporate bond in India. Economic vibrancy coupled with sophisticated state-of-art financial infrastructure has contributed to rapid growth in the equity market in India. In terms of market features and depth, the Indian equity market ranks among the best in the world. In parallel, the government securities market has also evolved over the years and expanded, given the increasing borrowing requirements of the government. In contrast, the corporate bond market has languished both in terms of market participation and structure. NBCs are the main issuers, and very small amounts of finance are raised by companies directly. The Economic Survey 2010-11 cites many reasons for the less developed bond market in India. 1. Predominance of banks' loans. 2. FII's participation is limited. 3. Pensions and insurance companies and household are limited participants because of lack of investor confidence. And 4. Crowding out by government bonds. The Economic Survey 2011-12 concluded that there is now ample empirical research to corroborate Schumpeter's conjecture that financial development facilitates real economic growth. The depth of the financial markets and availability of diverse products should, therefore, not be treated as mere adornment, but as critical ingredients of inclusive growth. Banks in India accounted for 14.4% of the financing of large firms in 2001, which rose further to 17.8% in 2010-11. The bond market, on the other hand, has been minuscule in comparison. The thinness of the bond market has been somewhat compensated by foreign borrowing done by Indians, which rose sharply over the last decade. Further, India is characterized by a disproportionate amount of secured borrowing. The small size of unsecured borrowing may, at first sight, not seem to be a matter of concern, but it could be a reflection of the weakness of contract enforcement and lack of adequate information. If contracts were quickly enforced and lenders had information on borrowers, they would be more willing to give unsecured loans. This would give a nimbleness to the financial markets, which they presently lack. There are many reasons why bond markets are important for an emerging economy. Prominent among these is the fact that they lead to more efficient entrepreneurship and greater value creation. When an entrepreneur takes a loan or issues bonds, all additional profit over and above the prefixed repayment amount accrues to the entrepreneur. So he or she is better incentivized to take sharper decisions. By having a weak bond market, we may be foregoing this efficiency. And further, this efficiency gap may well mean that there is less lending and hence less investment and entrepreneurship in the economy than is feasible. Further, as India tries to garner $500 billion from the private sector in the 12th Plan for Investment in the Infrastructure sector, having an active bond market would be a valuable avenue for raising money. There can be many reasons why, despite these advantages, the bond market has not developed adequately. One reason has to do with what economists call multiple equilibria. Consider a situation where the bond market is small. If someone buys bonds and later wishes to sell these off, he anticipates difficulty. Since the bond market is not active, he may not easily be able to sell the bonds, and thus he will hold simply because he cannot find a buyer. Hence, this may lead to discourage someone from buying the bonds in the first place. If everybody reasons like this, the bond market remains thin. Hence, the need is for a push that nudges the market to another equilibrium, where people readily buy bonds because they know that they can easily sell these off, and this becomes a self-fulfilling prophecy and sustains the large bond market. There is effort currently on to try to boost India's debt and bond markets, and success in this can give another fillip to growth. With the intervention of the Patil Committee, 2005 recommendations, the corporate bond market is slowly evolving. With bank finance drying up for long-term infrastructure projects, in view of asset liability problems faced by the banking system, the need for further development of a deep and vibrant corporate bond market can hardly be overemphasized. Recent initiatives for further development of corporate bond markets, taken in the year 2012-13 are as given below. 1. Banks allowed to take limited membership in SEBI-approved stock exchanges for the purpose of undertaking proprietary transactions in the corporate bond markets. 2. To enhance liquidity in the corporate bond markets, the IRDA has permitted insurance companies to participate in the repo market. The IRDA has also permitted insurance companies to become users of credit default swap (CDS). 3. The minimum haircut, i.e., the difference between prices at which a market maker can buy and sell a security, requirement in corporate debt repo have been reduced from the existing 10%, 12%, 15% to 7.5%, 8.5%, 10% for AA or A+ or R-rated corporate bonds. 4. MFs have been permitted to participate in CDS in corporate debt securities as users. 5. Revised guidelines on CDS for corporate bonds by the RBI provide that in addition to listed corporate bonds, CDS shall also be permitted on unlisted but rated corporate bonds even for issues other than infrastructure companies. 6. Users shall be allowed to unwind their CDS bought position with the original protection seller at a mutually agreeable or FIMMADA, Fixed Income Money Market and Derivatives Association of India, price. If no agreement is reached, then unwinding has to be done with the original protection seller at FIMMADA price. 7. CDS shall be permitted on securities with original maturity up to 1 year like CPs, certificates of deposit, and non-convertible debentures with original maturity less than 1 year. Till March 2020, the RBI had taken a number of measures to strengthen the corporate bond market in India. It accepted many of the recommendations of the Khan Committee, August 2016, to boost investor participation and market liquidity in the corporate bond market. The new measures as announced by the RBI include 1. Commercial banks are permitted to issue rupee-denominated bonds overseas, masala bonds, for their capital requirements and for financing infrastructure and affordable housing. 2. Brokers registered with the Securities and Exchange Board of India, SEBI, and authorized as market makers in corporate bond market permitted to undertake repo or reverse repo contracts in corporate debt securities. This move will make corporate bonds fungible and thus boost turnover in the secondary market. 3. Banks allowed to increase the partial credit enhancement they provide for corporate bonds to 50% from 20%. This move will help lower-rated corporates to access the bond market. 4. Permitting primary dealers to act as market makers for government bonds to give further boost to government securities by making them more accessible to retail investors. 5. To ease access to the foreign exchange market for hedging in over-the-counter, OTC, and exchange-traded currency derivatives, the entities exposed to exchange rate risk allowed to undertake hedge transactions with simplified procedures, up to a limit of $30 million at any given time. 6. Pension and Provident Fund together with insurance companies have been allowed to invest in the corporate bonds. 7. Corporate bonds rated BBB or equivalent declared as investment grade, as initiated by the Union Budget 2018-19, till now only R-rated corporate bonds were entertained as investment grade. 8. Introduction of an electronic platform for repos operation in corporate bonds. 9. Inclusion of them in the RBI Liquidity Adjustment Facility, LAF. 10. FIIs allowed to invest in the corporate bonds through stock exchanges and primary issuance, overall ceiling of $25 billion ceiling for G6. By March 2020, the corporate bond market amounted to about 32% of total credit to the corporate sector in India. It is believed that in the wake banks' unwillingness to lend, the corporate houses are going for corporate bond market. As per SEBI, by March 2020, the outstanding value of domestic corporate bonds in India was 22.3 lakh rupees crore, about 16% of GDP by December 2019. By comparison, According to the Asian Development Bank, China's local currency corporate bond market was about 30% of GDP and Malaysia's about 44%. This way, India has much scope to scale up its corporate bond market. Inflation-indexed bonds. To protect the returns of investors from the vagaries of inflation, the Reserve Bank of India plans to introduce inflation-indexed bonds, IIBs. It was proposed by the Union Budget 2013-14. The government hopes this will help increase financial savings instead of buying gold. In the recent years, the rate of return on debt investments has often been below inflation, which effectively means that inflation was eroding savings. Inflation-indexed bonds provide returns that are always in excess of inflation, ensuring that price rise does not erode the value of savings. In 2013-14, RBI launched two such bonds, the first one in June 2013 linked with the WPI, which had a very weak retail response, and second one in December 2013 linked with CPI. The latter one is called as Inflation-Indexed National Savings Securities Cumulative, INC, with a 10 years tenure. These are internationally known as inflation-linked securities or simply linkers. Interest rate on these securities would be linked to Final Combined Consumer Price Index, CPI, base 2010 is equal to 100. Interest rate would comprise two parts, fixed rate, 1.5%, and inflation rate, based on 3-month lag to CPI. Thus, if a bond is being valued in December, the reference rate will be CPI of September. The new offering should attract higher attention from savers, especially due to its link to CPI instead of Wholesale Price Index, WPI, which is a less accurate gauge of inflation. CPI is considered a more accurate gauge of the impact of inflation on consumers because it takes into account increases in the cost of education, food, transportation, housing and medical care. In WPI, the emphasis is on measuring the prices of traded goods and services. It was in 1997 that the IIBs were issued for the first time in India, named as the Capital Indexed Bonds, CIBs. But there remains a difference between these two bonds. While the CIBs provided inflation protection only to principal, the new product, IIBs provides inflation protection to both the components, principal and interest payments. Gold Exchange Traded Funds. Gold Exchange Traded Funds, ETFs, are open-ended mutual fund schemes that closely track the price of physical gold. Each unit represents 1 gram of gold having 0.995 purity, and the ETF is listed on stock exchanges. The net asset value of each unit is calculated based on the prices of physical gold prevailing on that day and is designed to provide returns that would closely track the returns from physical gold. E-Gold. E-Gold is another purchase option involving investments in units traded on the National Stock Exchange, NSEL. Here, the investor is required to have a demat account with an affiliate of NSEL. E-Gold's brokerage and transaction charges are lower than gold ETFs as there are no fund management charges. One can take delivery of gold or sell it in the exchange. But there is also a negative point here from the tax angle. Under e-gold, one has to hold the yellow metal for 36 months to enjoy long-term capital gain benefits, and this is taxed at 20%. For ETFs, exchange-traded funds, and gold funds, the holding period to be classified as long-term is only 1 year. After a year, ETF and gold funds will suffer 10% tax without indexation and 20% after indexation. For a small investor, gold ETF would appear to be the best option, as it meets his needs without difficulties in terms of creating a separate demat account, tax implications, and wealth tax. CPSE ETF. The Central Public Sector Enterprises Exchange Traded Fund, CPSE ETF, comprising the shares of 10 blue-chip PSUs, was listed on the BSE and NSE platforms on 41 April 2014. The Government of India expected to raise a corpus of 3,000 crore rupees through the fund, while it got oversubscribed to the tune of 4,300 crores rupees. This scheme is conceived by the Government of India as a means to disinvest a part of its holding in public sector units, PSUs, and would be managed by Goldman Sachs Asset Management, India, PVT Limited, a mutual fund company that specializes in managing exchange-traded funds. ETF is a security that tracks an index, a commodity, or a basket of assets, such as an index fund, but trades like a stock on an exchange. The CPSE ETF tracks the CPSE index of 10 PSUs included in the ETF. CPSE index has been constructed by including companies that meet the following criteria: 1. Owned 55% or more by the GOI and listed on the NSE. 2. Large PSUs, those having more than 1,000 crores rupees as average free float market capitalization for 6 months period ending June 2013. And 3. With a consistent dividend payment record, at least 4% for 7 years immediately prior to, or 7 out of 8 or 9 years immediately prior to June 2013. The 10 blue-chip PSUs which meet the above criteria and their weightages are ONGC 26.72%, GAIL India 18.48%, Coal India 17.75%, REC 7.16%, Oil India 7.04%, IOC 6.82%, Power Finance Corp 6.49%, Container Corp 6.40%, Bharat Electronics 2%, and Engineers India Limited 1.13%. CPSE ETF will invest the corpus in the above given companies as per the given weightage. Hence, subject to the tracking error and expenses, CPSE ETF's returns will closely correspond to the CPSE index returns. Meanwhile, the government has announced Union Budget 2017-18 to launch a new ETF with diversified CPSE stocks and other government holdings in the fiscal 2017-18. Pension sector reforms. Pension has been the integral part of government jobs in India. Pension serves two important socio-economic objectives. 1. It facilitates the flow of long-term savings for development, i.e., nation building, and 2. Also helps establish a credible and sustainable social security system in the country. The new pension scheme, now renamed as National Pension System, NPS, was introduced by the government on 22 December 2003, and it was made mandatory for central government employees, except armed forces, who joined service WF 1 January 2004. The scheme was extended to the state governments, and as of now 28 state governments have notified NPS for their employees. The scheme was extended to all citizens of the country on voluntary basis from May 2009. Although the NPS is perhaps one of the cheapest financial products available in the country, in order to make it affordable for the economically disadvantaged, the government in September 2010 introduced a lower-cost version, known as Swavlamban scheme, which enables groups of people to join the NPS at a substantially reduced cost. As per existing scheme under NPS, Swavlamban could be availed either in unorganized sector or in NPS Lite. NPS Lite is a model specifically designed to bring NPS within easy reach of the economically disadvantaged sections of the society. It is extremely affordable and viable due to its optimized functionalities, available at reduced charges. Under the Swavlamban scheme, the government provides subsidy to each NPS account holder, and the scheme has been extended until 2016 to 17. A customized version of the core NPS model, known as the NPS Corporate Sector Model, was introduced from December 2011 to enable organized sector entities to move their existing and prospective employees to the NPS under its corporate model. All public sector banks have been asked to provide a link on their website to enable individual subscribers to open online NPS accounts. As per the Economic Survey 2012-13, the pension reforms in India have generated widespread interest internationally, but before universal inclusion of poorer sections of Indian society into the pension network is a reality, the economy needs to solve the following major challenges. 1. Lower levels of financial literacy, particularly among workers in the unorganized sector. 2. Non-availability of even moderate surplus. 3. Lukewarm response so far from most of the state or UT governments to a co-contributory Swavlamban scheme. And 4. Lack of awareness on the supply side about the NPS and of access points for people to open their accounts individually have been major inhibiting factors. During 2015 to 16, the government launched a new pension scheme, the APY, Atal Pension Yojana. The scheme provides a defined pension, depending on the contribution and its period. The subscribers to it will receive a minimum pension of 1,000 rupees, 2,000, 3,000, 4,000 or 5,000 per month, from the age of 60 years, depending on their contributions, which are themselves based on the age of joining the scheme. The scheme is open to all bank account holders. The central government co-contributes 50% of the total contribution subject to a maximum of 1,000 rupees per annum to each eligible subscriber's account for a period of 5 years, from 2015 to 16 to 2019 to 20, who joined the APY between 1st June 2015 and 31st March 2016, and who is not a member of any statutory social security scheme and is not an income taxpayer. By September 2019, the APY has a total of 1.78 crore subscribers and asset under management, i.e. returns on the corpus, of 8,743 crores rupees. Till 30th September 2019, a total of around 3.06 crore subscribers, including Atal Pension Yojana, have been enrolled under NPS. Assets under management, which includes the returns on the corpus, under the NPS increased to 3.71 crores rupees between March to September 2019, showing a growth of 16.71%. Changes in NPS during 2019 to 2020. Some major steps taken by the government in 2019 to 2020 related to the NPS are as given below. 1. Choice of fund. Similar to subscribers of the private sector, government subscribers, also allowed to choose any pension funds including private sector funds, can be changed once in a year. 2. Choice of investment pattern. Government employees may exercise one of the following choices of investment pattern twice in a financial year. For both existing and new subscribers, the fund will be allocated among the 3 existing public sector fund managers under the guidelines of the PFRDA. Government employees who prefer a fixed return with minimum amount of risk have been given an option to invest 100% of the funds in government securities. Government employees who prefer higher returns shall be given the options of the following to life cycle-based schemes, A. Conservative life cycle fund with maximum 25% exposure to equity. B. Moderate life cycle fund with maximum exposure of 50% to equity. Financial Stability Development Council, FSDC. An apex-level body, the FSDC, was set up by the GOI in December 2010. It was in line with the G20 initiative, which came in wake of the financial crisis among the Western economies triggered by the 2007-08 subprime crisis of the USA. The Council has the following objectives: 1. To strengthen and institutionalize the mechanism for maintaining financial stability, 2. To enhance interregulatory coordination, and 3. To promote financial sector development. The Council is chaired by the Finance Minister and has heads of financial sector regulatory authorities, the Finance Secretary, and/or Secretary of the Department of Economic Affairs, Secretary of the Department of Financial Services, and the Chief Economic Advisor as members. Without prejudice to the autonomy of regulators, the Council monitors 1. Macroprudential supervision of the economy, including functioning of large financial conglomerates, 2. Interregulatory coordination and financial sector development issues, and 3. Financial literacy and financial inclusion. Financial Sector Assessment Program, FSAP. The IMF board decided in September 2010 to include 25 systemically important economies, including India, under the Financial Stability Assessment Program, FSAP, for members with systemically important financial sectors. The joint IMF World Bank Financial Stability Assessment Program, FSAP, was conducted for India in January 2013, which assessed Indian financial system in relation to the highest international standards. The assessment recognizes that the Indian financial system remained largely stable on account of a sound regulatory and supervisory regime. However, the assessment identifies some gaps in 1. International and domestic supervisory information sharing and cooperation, 2. Consolidated supervision of financial conglomerates, and 3. Some limits on the de jure independence of the regulators, RBI and IRDA. Despite having reservations on few issues, overall the Indian authorities expect the FSAP exercise to play a significant role in shaping India's post-crisis initiatives to strengthen the regulatory and supervisory architecture based on the evolving international consensus as well as careful examination of their relevance in the India-specific context. As a member of the FSB, BCBS, and IMF, India is actively participating in post-crisis reforms of the international regulatory and supervisory framework under the aegis of the G20. India remains committed to adoption of international standards and best practices in a phased manner and calibrated to local conditions, wherever necessary, as it is a country characterized by complex and diverse socio-political and economic conditions. Financial Action Task Force, FATF. The FATF is an intergovernmental policy-making body that has a ministerial mandate to establish international standards for combating money laundering and terrorist financing. India joined the FATF as its 34th member in June 2010. At present, the FATF has 36 members comprising 34 countries and 2 organizations, European Union and Gulf Cooperation Council. Real estate and infrastructure investment trusts. The SEBI firmed up regulations that will govern real estate investment trusts, REITs, and the infrastructure investment trusts, InvITs. The long-pending proposal of 2008, the trusts have the objective of enabling the cash-strapped real estate and infrastructure developers to have easy access to funds. They create a new investment avenue for institutions and high net worth individuals and eventually ordinary investors. REITs. Major provisions announced by the SEBI for the REITs are as given below. 1. To be close-ended real estate investment schemes that will invest in property with the aim of providing returns to unit holders. 2. The returns will be derived mainly from rental income or capital gains from real estate. 3. Allowed to invest in commercial real estate assets, either directly or through special purpose vehicles, SPVs. In SPVs, a REIT must have a controlling interest of at least 50% of the share capital and will have to hold at least 80% of their assets directly in properties. 4. To raise funds only through an initial offering, and units of REITs have to be mandatorily listed on a stock exchange, similar to initial public offering, IPO, and listing for equity shares. 5. Required to have assets worth at least 500 crore rupees at the time of an initial offer, and the minimum issue size has to be 250 crore rupees. The minimum subscription size for units of a REIT on offer will be 2 lakh rupees, and at least 25% of the units have to be offered to the public. 6. Will be able to raise money through follow-on offers, rights issues or qualified institutional placements, and the trading lot for such units will be 1 lakh rupees. According to the norms, although a REIT may raise funds from any type of investors, resident or foreign, initially only wealthy individuals and institutions will be allowed to subscribe to REIT unit offers. The market regulator said a REIT may have up to 3 sponsors, with each holding at least 5% and collectively holding at least 25% for a period of at least 3 years from the date of listing. Subsequently, the sponsor's combined holding has to be at least 15% throughout the life of the REIT. Similar to the practice in the US, Australia, Singapore, and other nations where REITs are common, SEBI has decided to allow these trusts to invest primarily in completed revenue-generating properties. To ensure that REITs generate continuous returns, SEBI said at least 80% of the REIT's assets has to be invested in completed and revenue-generating properties. And only up to 20% of assets can be invested in properties that are being developed, mortgage-backed securities, debt of companies in the real estate sector, equity shares of listed companies that derive at least 75% of their income from real estate, government securities, or money market instruments. No REIT can invest more than 10% in properties that are under construction. InvITs. SEBI also announced the launch of InvITs, which are somewhat similar to REITs. However, an initial offer will not be mandatory for InvITs, though listing will be mandatory for both publicly and privately placed InvITs. Major provisions are as given below. 1. It can invest in infrastructure projects, either directly or through an SPV, special purpose vehicle. In case of public-private partnership, PPP, projects, such investments will be only through an SPV. 2. While listing, the collective holding of sponsors of an inventory IT has to be at least 25% for at least 3 years. 3. Required to have a holding worth at least 500 crore rupees in the underlying assets, and the initial offer size of the inventory IT has to be at least 250 crore rupees. 4. Any inventory IT, which looks to invest at least 80% of its assets in completed and revenue-generating infrastructure assets, has to raise funds only through a public issue of units, with a minimum 25% public float and at least 20 investors. 5. The minimum subscription size and trading lot of such a listed inventory IT has to be 10 lakh rupees and 5 lakh rupees, respectively. A publicly offered inventory IT may invest the remaining 20% in under construction infrastructure projects and other permissible investments. An inventory IT that proposes to invest more than 10% of its assets in under construction infrastructure projects can raise funds only through private placement from qualified institutional buyers with a minimum investment and trading lot of 1 crore rupees and from at least 5 investors, where single holding cannot be more than 25%. Recent developments to promote the real estate and infrastructure trusts. A friendlier tax regime was put in place by the GOI through two successive union budgets, 2014-15 and 2015-16. However, the idea of the trusts could not get much momentum. Basically, due to subdued market conditions in the sectors attracting investors, new, greenfield, project or a trust has remained difficult by now. Majority of the existing projects in the sectors are running into losses with weak balance sheets of their developers, unable to even service their bank loans. To push the cause of the trusts, by in 2019-20, the Security Market Regulator, SEBI, permitted the Foreign Portfolio Investment, FPI, in the trusts. How much interest the FPIs will show in the trusts, it will be known only in future. Meanwhile, experts believe that real momentum in the sectors can be only expected once economy comes out of the spell of economic slowdown.